Hey, everybody, it's that time of year, crunch time at the end of the year, and there's 5 things we all need to pay attention to when it comes to taxation and things that we should consider before the year ends. So let's jump in. Charitable giving, please do this the most efficiently way possible. There are tax credits in some states. You can give money and get an actual dollar for dollar tax credit for the money you're donating on your tax return. So some states are doing that, like Arizona. So take advantage of those before the end of the year. Some of them you can donate all the way up until April of next year, but you want to get them done in 2023 within the calendar year, because several of them go away once the calendar year's over. Bundling 2 years. Those of you that are considering itemizing, or you are on that borderline of itemizing versus the standard deduction, consider giving this year's and next year's in 1 year, so you have the double deduction. That'll boost your itemizing, and then take the standard deduction next year. So every other year we want to pile in all of those deductions, and that's going to be a lot more powerful in 2026. I just got done making a video on all the sunset clauses of these tax returns, and we're going to go back to itemizing in 2026. So look for that video. Qualified charitable distributions. If you are over 70 and a half, you are charitable, you should only give through your IRA. It is by far the most effective and efficient way to get tax advantages from giving to charities, which for most of us is not the reason we give to charities, but this is the most efficient way for you to get the benefit on your tax return. All you do is call your IRA. You have to be over 70 and a half. Whoever holds the IRA, Schwab, Fidelity, whoever, call them and say, hey, I want X amount of dollars to be sent directly to this charity. The 1099 will show up showing the distribution, but it will show as zero taxable. That is very effective on a tax return and allows you to get the benefit of that, that charitable distribution, and take your standard deduction on top of that. That's huge. You don't have to itemize to get that charitable deduction. Next one is tax loss harvesting. So understand, this is the idea of offsetting capital gains with capital losses. Think about this. If you do nothing year over year over year over year, and you listen to me and you own things like the S&P 500 fund, okay? You sit there, you own this fund, it grows, it grows, it grows, it grows, it grows, it grows. You do nothing, and then all of a sudden you need money, and all you got is just lots of growth in there. And look, growth is good, but now you got to pay taxes on all of it when you needed the money, right? It's kind of like going into retirement and only having IRA money. Well, it's great that you saved this big pile of money, but now every time you need a dollar, it's all taxable. So by being proactive, you have this account, it's growing, it's growing, it's growing. Well, maybe you have a couple of positions that have losses in it. Maybe you sell those lost positions and then sell some of the gains, and it's a wash. And you can sell a little extra losses and have $3,000 up to $3,000 to offset ordinary income as well. This is just little tweaking that can be done along the way, and that is going to help your individual portfolio. So understand that you have to reinvest the money in a different investment. You can't just sell IBM and buy IBM and capitalize on the losses. You can do that to capitalize on gains, but not losses. So you do have to maybe buy an ETF that owns IBM as opposed to only owning that individual stock. So lots of things you can do on the tax loss harvesting, especially for people that own lots of individual positions. This is labor intensive, but very effective and should be done every year towards the end of the year. Retirement contributions. Time to take a look back at your year and figure out whether you're in the higher tax brackets or the lower tax brackets and make your contributions, right? There are rules on who is allowed to contribute to IRA or Roth accounts You have to have earned income. There are income restrictions on whether you're allowed to do this. So don't just wake up and throw money in there. Know the rules and know whether you can or can't. But here's the bigger one. And I always say your advisor or yourself needs to understand taxation and be able to talk about this, right? We need to know whether we should be putting into the Roth 401k or the traditional 401k, the Roth IRA or the traditional IRA. We have to make the right decisions on these things. We also have some plans out there that'll allow us to contribute up to $66,000 between you and your employer, which means there's opportunities on the what they call non-qualified part of your 401k. So there is so much that can be done out there, and maximizing the use of these tools is really about creating an efficiency in your portfolio. Because if you're saving money and you're not spending it, saving it is the first part of the battle, but the second part is saving it efficiently. Taking advantage of our tax laws and how they work and making sure we're contributing and saving in the right manner. That is the important part. That's how we create the efficiencies and make a difference out there. Withdraw your RMD. I have to say this because any of you that are in the required minimum distribution stage, it has been a bouncing ball over the last couple of years, to be real honest. We went from 70.5 as the required beginning date to 72, which notice there's only a 6-month window of people that had to start at 72. That's how quick they were changing these stupid things. So now at 73, I'll move my head out of the way. 73, you have to be born between 1951 and 1959. Obviously, now we have 1976 or 1960 and later, we will be taking at 75. So these are the required beginning dates, but that's not my concern. My concern is one of the changes that nobody noticed and nobody's even, had to worry about it yet. Look, the penalty for not taking your required minimum distribution was 50%. That means if your required distribution was $20,000, the penalty is $10,000. And this is why I think the IRS just never, they always said, oh, okay, we'll forgive you. We've seen, look, I own a tax firm. We've seen a lot of people miss their required minimum distribution. You notice it early in the next year, you take it out, you write the letter to the IRS with your tax return saying, so sorry, I was in the hospital, I missed it, but I took it out and I hope you'll forgive me. And they always forgive you. So I've never seen anybody actually pay that 50% penalty. Well, here's the change. They dropped the penalty to 25%. And they flat out admitted that if you remedy it within 2 years, they'll drop it even further to 10%. So that's good news, right? Well, I don't know. Because to me, that means they're going to start enforcing this. So if you fail to take your required distribution, the penalty is no longer 50%, it's 10%. But instead of forgiving everybody, I have a feeling they did this because they're actually going to start penalizing people. So take your required distribution. If you are older than 70.5, 72, 73, 75 with birth dates here, that is when you have to begin taking those required distributions. And I got plenty of videos on those and teach classes on those as well. Number 5, look, taxation is supposed to go up in 2026. It's not a surprise. We are under a temporary reduction of taxation that was implemented in 2017. It was always temporary. We need to take advantage of these tax brackets. I have a bold line here. If your total taxable income as a married couple is less than 117 or 58 as a single person, and that's under 65, it's a little bigger. It's about 120,000 if you're over 65, 60,000 if you're single. If you're under those numbers as total income for the year, holy cow, everything revolving around your world should be Roth. You should be taking advantage of these lower tax rates. choose to pay 12 so you don't pay 15, 20 plus later. Okay. For those of you that are in the higher tax brackets, we need to look at the bigger picture and decide, are you always going to be in these higher tax brackets? Because 22 and 24 is a lot better than 25 and 28. If you're in the 30s, these don't adjust much. 33 goes to 30, or 32 goes to 33, no big deal. So everybody's in a different situation, but this is so important to be proactive, knowing that taxation is already set to go higher in 2026. Nobody is pushing it higher. It is set to go higher because we are under a temporary reduction. So you're taxed one bucket at a time. Certainly you should be choosing to fill up that 12% tax bracket here. Absolute no-brainer for most people. Okay. Withdraw and pay taxes in lower tax brackets. That's why I say that. And then spread out withdrawals as long as possible. Okay. So we need to be proactive. The more proactive we are, the more efficient we're going to be. The more efficient we're going to be, the less taxation you're going to have. I talk a lot about efficiency. A good financial planner is going to create a lot of efficiencies. It's going to save you a lot of taxation in the future. So important when it comes to putting a portfolio together and managing that portfolio, understanding this taxation, and Roth conversions are a big part of that. You're never too old for Roth conversions. All right, I hope that helps. That's the 5 things that you've got to consider before the end of the year. Think through these. Some of you, you can check off a couple of them, don't apply to you, but some of those you really got to pay attention to every year. It's time to sit down and do that before the big holidays at the end of the year start hitting. You got a couple of weeks to put some attention to this and get it done. Certainly I can help. I'm always here to help. We were launching a new site to schedule appointments. I have no problem helping out wherever I can, and we're very flexible in the ways that I can help. So give us a call, shoot us an email. Always happy to look through situations and try to create these efficiencies and have these year-end conversations as well. Give us a call, shoot us an email, share the video. If you're not a subscriber, I'm putting new videos on every single week. Subscribe to the channel every week, 2-3 videos heading out your way. And we will see you next week. Thanks again.